Welcome back, everyone. Today on the Joseph Carlson Show. The market has entered into this week with a bit of jitters. We saw some nervousness from investors because we don't know how this earnings season is going to pan out. But we're getting some early data. The big banks just reported their profits this morning, and across the board, they just crushed it, posting record profits, surging profits, and giving decent guidance. We have, for example, JP Morgan up 2%. Which is in line with the market, so that's not too impressive, but JP Morgan was actually the weaker bounce of all the rest of the banks. We have Goldman Sachs up 5.6%, Wells Fargo up 5.9%. We have Citigroup up 7.72%, and of course Bank of America up 3.1%. So across the board, all these banks are trading up after they're reporting record net income, record buybacks. We have the bank CEOs very bullish, but not everyone in this market is bullish, and there's still a lot of people that doubt going into 2025. One of them is David Rosenberg. Now, David Rosenberg is not always the most optimistic individual, but he does have some solid data he shares. For example, he says that right now, multiples are at a 2.3 deviation event. And he explains when this has occurred throughout history and what the future expected returns look like. So he paints a pretty grim picture in terms of valuations for the market. Not only does he warn about multiples, but he's also one of the individuals that sounds the alarm on passive investing. And this is a theme that I've seen. Many money managers and experts are warning about index funds or ETFs, saying that they are momentum-based, that they're bubble-driven. We already have seen this from Terry Smith, explaining why he's underperformed and giving a warning about index investing. And so I want to dive deeper into this subject. Is index investing or passive investing really problematic? Is it really a bubble? Is it really just momentum? We're going to look at some of the actual data in this episode. Now, not only that, we also have news of the TikTok ban. It is imminent, going into effect possibly this week. And Mark Mahaney explains which companies will benefit from this TikTok ban. And then finally, as we get through this week, possibly the most important earnings of the week is TSM, where they'll explain what's going on with the semiconductor business. I'll be going over the most critical things to look for in TSM's earnings. So we have a ton of stuff to get into. Let's go ahead and jump in. Now, before we jump into David Rosenberg's gloomy thoughts on the market, I think it's good to look at what's happening today. We had this week, going into earnings season, the market was a bit jittery, a bit nervous, I think understandably so. Valuations are a bit higher now, and we have this earnings season of Q4 reports to see how things are going. Leading into this week, the companies that really were reporting earnings were the banks. Now, the way to look at banks' earnings and what they mean for the broader economy is investing in a bank is basically investing in their balance sheet. So if a bank is invested in a lot of car loans, that means that when you're investing in the bank, you're investing in the car loan business. You're investing in their balance sheet. You're dependent on how those car loans are being repaid. If people are repaying the car loans, the bank's earnings are going to do well. That's Ally Financial. With these banks, the big four like JP Morgan, Citi, Wells Fargo, and Bank of America, their balance sheets is the US economy. Broadly speaking, that is the balance sheet of these four banks. So when they report good earnings, it means there's overall strength in the US economy. And that's a positive thing. So it makes sense that stocks are surging 2 to 3% today based on the strength of these reports. They say the banks benefited as big corporate clients grew optimistic about the economy and incoming Trump administration, spurring a return of deal-making, fundraising, and trading. So right now, we still are on the Trump sugar high. We have a president coming in that's promised to lower barriers of entry, to lower taxation, to lower regulation, and that obviously gets the business world buzzing. People right now are excited about it. Another interesting thing about how this works is right now Trump hasn't even taken office yet. So he hasn't changed anything. Everything is the exact same, but now investments are being done, deals are being made, because this type of promise is self-reinforcing. When business leaders are excited about the future and they feel optimistic, that is a self-fulfilling prophecy. It's something where it's self-reinforcing. More people are making deals just on the promise that things are going to be better in the future. Bankers say that an enormous appetite of capital is being driven by acceleration of deal activity and companies' financing needs. So already we're seeing a spur in growth. Corporate clients and CEOs around the world are increasingly confident and looking to finance big ticket investments, ranging from data centers to major technology upgrades. That has the banks projecting more business in the incoming months. Now, there's a couple different takeaways from this, but one of them is that CapEx is going to continue to climb. When they say making big investments, these big investments drop to the capex line of different businesses. And we've seen that repeated by all of big tech companies, that they're investing greater amounts into their data centers. But we're also seeing this with the banks, where they're giving out loans to different companies for making these investments. So I think right now, based on the earnings of banks, we're going to see more and more capex in 2025. And this is all again driven by optimism, that virtuous cycle that's happening in the business world today. There's no question that there's a significant amount of increase of optimism in the overall environment. We're obviously happy to see more optimism in the C-suite of the country and even globally in some pockets. The bank's profits in particular were strong in Q4. Goldman Sachs profits more than doubled to $4.1 billion, amounting to $11.9 a share. Citigroup saw similar strengths, posting $2.86 billion compared with a year ago of $1.84. Wells Fargo's fourth quarter profits rose 47% to $5.08 billion. All the banks posted profits that were better than expected. So all the major banks across the board crushed their earnings by huge margins. These are big beats over their estimates, and they say that they're optimistic about the future based on sentiment from all the business leaders. People are using the banks. And again, these banks are overall representative of the entire US economy, all the people that they do business with, and they're heavily diversified. We have JP Morgan with trading and investment banking. We have wealth management services. We have corporate banking where they take out loans to build construction and capex and data centers. And then, of course, we just have consumer banking, which has personal loans, private loans, car loans, and we have credit cards. People are spending with their credit cards and paying back the loans. So overall, there's no other way to read this than it's positive for the US economy. But even so, even with this good news, there's some people that are a little bit hesitant about what's going on, and David Rosenberg is one of them. Let's go ahead and take a look at this interview. And I will warn you, David Rosenberg, just to give some context here, some background, there's some people that I put in the camp of mostly bearish. I don't want to use the term perma-bear, because perma-bear means that they're literally never optimistic. And I don't know that. I don't know if David Rosenberg has never been optimistic, but I would say that overall, most of the things I read, most of what I see is that he has a bearish stance. Now, that doesn't mean that he's wrong, but it does mean that that's his stance. Now, with giving that context, I do want to look at this interview because it's getting some buzz here, and I want to address some of the claims he makes. He starts off by saying that what we're in right now, the situation currently, is a once-in-a-lifetime event.
Maybe it's not once in a lifetime. Maybe it's twice in a lifetime. Well, look, we have a situation where the multiple in the S&P 500 is now a 2.3 standard deviation event. And we've only been this expensive on the S&P 500 in 1929, in 1999, and we were there briefly back in late 2021. Both foreshadowed pretty rough years for the market that nobody saw coming because the tendency for investors, well, for everybody, is to always extrapolate the most recent experience into the future. So I'm not going to say that valuations are a great timing device, but they're either a headwind or they're a tailwind. Big tailwind in the summer of 1982, big tailwind in 1991, big tailwind in 2003, big tailwind in 2009, big tailwind in 2020. This is a huge headwind for the market in terms of expected future returns. So that's the major point.
Now, so far, I agree with everything he said. He says that valuation is not a timing event. Instead, it's a headwind or a tailwind. Throughout the past 20 years, valuation has mostly been a tailwind. There's certain circumstances where it's been a headwind, and it affects future expected returns. All of this checks out. I think all of it makes sense.
Price is what you pay, value is what you get. And of course, the S&P 500 is populated with the best companies in the world. Who doesn't know that? All I hear about is US exceptionalism. Is that new? You see, this is what happens in my industry, right? Is that pundits take the narrative to fit into the price action. The US has always been exceptional. And these are the best companies in the world. However, there's just too much priced in as far as what their future growth prospects are. Next 5 years, the market is anticipating, this is what's priced into the market, 20% average annual earnings growth in the S&P 500 for the next 5 years. That's almost triple the historical norm. If you believe that's going to happen, if you believe that AI is going to drive productivity that higher and business costs that much lower, that we're going to get 20% earnings growth in the next 5 years, then I would suggest this market is for you. Not for me, maybe it is for you.
Right.
Valuations are just too high for my liking.
Now, he claims that what's priced in right now is 20% earnings per share growth for the next 5 years. That obviously is not going to happen. So he's correct there again in the thought that this 20% growth is not going to happen. But I would also argue that I don't think that's what's being priced in right now. I think that his assumptions that investors are expecting 20% CAGR growth in the S&P 500 is not really what most investors are expecting. I think the situation right now is more so that investors are looking at the only place that they can put their money where they can get a semi-attractive return. You can either put it in savings accounts and get 4% returns. You can go outside of the US market and invest in the lower quality companies, not the exceptional American companies. See what happens there over the past 50 years. You can look at the numbers there. Or you can take your chances with the US market, where even if it doesn't grow 20% CAGR per year, even if it grows 15% or 12%, in most situations, it does better than the rest of the world. That's why investors are starting to turn to the US markets. The companies in the US markets, he says it in kind of a derogatory term, that pundits call them the best companies in the world. They've been right. And the people that have recognized that for the past 5 years have been right. Putting most of my money in big tech over the past 5 years in the US market has been the right call. Not just because valuations have increased, but these companies have trounced the performance of other companies. But let's go ahead and move even further into this.
Now, in terms of this AI-fueled rally and the valuations that we're seeing, can you make comparisons to the 90s?
I think that you can. I mean, it's not the same, but it is similar. And everybody always says to me, well, that was all dot-coms. That was a dot-com bubble. No. It was not just a dot-com bubble. We called it TMT back then. I was at Mother Merrill. We called it TMT, technology, media, telecom. You couldn't tell them apart. But you had Cisco, you had Dell, you had Intel, you had IBM, Microsoft. They all got caught up in the broad tech bubble. And these were real companies with real business models and real earnings, just like you would say about the companies today. Those are real cash flows, real earnings, real business models. So it wasn't just pets.com that went defunct. All these companies that are still around today went down between 60 and 80% from 2000 to 2003, and then they were in the penalty box for the next 10 years. Oh, by the way, this is even as the internet was boosting productivity and changing all our lives at a personal level. At a professional commercial level, all that and then some got priced into the peak. And that's what's similar right now. Generative AI, ChatGPT, this is a game changer, big time. But that's what the markets do, right? This is what I love about economics and the markets, is the markets are more volatile. They shoot first, ask questions later. And what I'm saying is that what is similar is that the last time you had a 20% CAGR, 20% annualized growth rate for earnings over a 5-year span, not 1 or 2, 5 years, was back in the late 1990s. Bottom line is that we know what happened next. So I'd say there's more similarities and differences under the proviso that it is not exactly the same.
So there we have it. We get the comparison to the dot-com bubble in 2000. Now, I've been investing for well over 10 years. In that time period, I paid attention to a lot of different commentators and people that make market calls. And one thing that I will tell you is everyone like David Rosenberg. You can name off anybody that's mostly bearish or has made very bearish calls throughout history. And inevitably, invariably, every single one of them references the dot-com bubble over and over and over again. Anytime you want to scare people out of the market, reference the dot-com bubble. Look at the big drop that happened. Tell about how scary it was. Tell about how there was dead returns for a decade. It's been used over and over again to scare people out of the market. In 2018, people were referencing the dot-com bubble. 2019, the dot-com bubble. 2015, the dot-com bubble. I heard it the first day I started investing about the dot-com bubble. I would argue that to David Rosenberg or anybody else that's making this comparison to the dot-com bubble, that there has never been a time period where more money has been lost, not by investors that lost money in the actual dot-com bubble, but by people referencing the dot-com bubble to scare future investors out of the market. I think it would be interesting to add up how much money has been lost by people taking their money out of the market because they are scared that a dot-com bubble-like event is going to happen. In the words of Peter Lynch, more money is lost by anticipating different market sell-offs, market bubbles, than actually in the market sell-offs themselves. He notes that when investors make decisions based out of fear, they lose money. When they stay out of the market, they lose money. Even market commentators like Howard Marks, that called the dot-com bubble, he was one of the ones that successfully called the bubble itself, says that investors should stay invested. He says that they should not get out of the market, even with valuations being high, because the risk of getting out of the market is so much higher than having a big bubble event. Getting out of the market and having earnings grow, having companies continue to compound is more costly. So I agree, there can be some comparisons to make. He says that it rhymes, but there's also a lot of differences structurally with the dot-com bubble than the current market today, even with valuations being similar. First of all, the dot-com bubble companies like Microsoft were not the same companies they are today. They are structurally different. Sure, they had the tailwind of the internet, but the internet was really established. High-speed internet took off 10 years later. That's when Apple had the App Store. That's when internet usage really took off. Right now, we're in a situation, like Jeff Bezos says, where we have multiple golden ages at once. We not only have the internet continuing to advance these companies on a global scale, never before seen, but we have that in combination of artificial intelligence. We have boundaries. Companies' boundaries are so much wider now. Companies like cable companies were landlocked to specific geographic areas. Companies like Netflix can grow across the entire world. The companies right now are operating on an entirely different scale than they were before. So I don't buy the comparison that it's the same companies like Microsoft and Dell. The companies were very different back then. I don't think they're nearly as strong, and I don't think the same multiple should have been applied. And also, at the peak of the dot-com bubble, many of those companies were trading at 60 plus PE ratios. They weren't trading at the 25 to 30 they are today. Now, the next thing he covers is the question of the index fund, the vehicle for retirement for most people, which is an ETF investment. This is called passive investing, when you just throw your money in an ETF and leave it. And he says that this is problematic.
We have double concentration. We have the same degree of concentration on the mega cap stocks and technology that we had back in the late 1990s. So if you're talking about what's similar, the degree of sector concentration is about the same as it was back then. It's a very bifurcated market. What's different is that for the first time ever, households in the United States, not Canada, in the United States, have more than 70% of their financial asset mix in the equity market. And 60% of that almost is in ETFs. Passive index funds. So you have a record degree of concentration in the stock market, coupled with record degree of concentration in household balance sheets and risk. And the marginal household in the United States, with the 401ks nice and fat with this big AI trade, they don't have a bloody idea what they even have in their portfolio. Active managers, they've been lagging the index, of course, because they focus on risk and they focus on concentration risk. The way you've beaten the market or matched the market is by taking on extreme concentration risk. If you remember going back to the old Nortel days in the late 1990s, that worked until it didn't work. But you see, that's my big concern, is that when we go to the other side of the mountain, and we always do, there's bull markets and bear markets, they coexist. In the next bear market, it's going to not just be a financial event and an economic event, it's going to be a social event. Because everybody is all in all at the same time, and everybody thinks they can time the peak all at the same time, and that's not going to happen. But the fund flow, the concentration in equities is so huge that what happens when you get all the selling and there's no bid on the other side? Nobody talks about that. You see, when I talk about that, eyes just glaze and they roll. Because, of course, the extrapolation for the last 2 years of 25% returns, people think that's going to continue. You look at all my competitors on Bubble Vision, that's all they talk about. You have to ask yourself the question, why? Why does Warren Buffett, for the first time ever, why is he sitting on a 30% cash hoard? Okay? I'm not going to bet against his experience. A lot of people think, they said in the late 1990s that he lost it. Right. He's a Luddite. So we'll see. My recommendation more or less matches how Warren Buffett's positioned right now, which is very conservatively.
Right, and we'll get
So his actual recommendation isn't that extreme. It's just to be a little bit more conservative right now, like Warren Buffett is, which I agree with. I don't think that's a bad recommendation. But he also went on to rail against passive index investing, which the majority of Americans are doing, the majority of people are doing. This is something where he's sounding the alarm, saying that there's concentration risk and people have no clue what they even own. They're just throwing money into it, right? Paying any price. We also had Terry Smith say the same thing, that there's a huge concentration risk in companies like Nvidia. We also have people like Cathie Wood railing against passive index investing at the peak of 2021. We also had people like Michael Burry say the same thing nearly 20 years ago. This has been a common theme from money managers for literally decades, to be critical of passive index investing. And they make many claims that are simply not backed up with the data. For example, one of the key arguments here that David Rosenberg makes is that when calamity happens, when problems happen, that passive index investors are going to search for the exits. They concentrated in and they're going to concentrate out of the market. It'll cause a social event. People sell like crazy. Well, we can actually look at this claim. This is from Nick Majuli, where he goes over many of these criticisms that have existed for a long period of time for passive index investing. There's basically three types of claims that the people against passive index investing or warning about it are making and have made over the past 10 years. One of them is price distortion. This is the claim that Terry Smith made. That passive index investing distorts prices in the market, causing a momentum effect that makes the biggest stocks even bigger. So Terry Smith is saying the reason that big tech is so big is they were just driven up by momentum. People are putting money in the market, the price goes up of big tech, and they make more gains. Kind of saying it's unfair, and that's why the market's doing really well. Our fund doesn't hold all the big tech companies, so we're not doing as well. So price distortion or price discovery is one of the claims. The second one is market instability. This is the claim that David Rosenberg is making. Passive investing leads to more market instability. If lots of people don't know what they own, they're going to be scared. They're going to sell out all at the same time as soon as the market hits any troubles. And then the third one, which we've seen lots of investors claim over the years, is corporate governance issues. Passive investing leads to increased market concentration among fund companies, leading to corporate governance concerns. Now, on the first one, the price discovery issue, this again is the exact argument that Terry Smith was making. Formally, this is known as the positive feedback loop argument. A fund buys a stock, the stock price goes up, the higher price leads to better returns for the stock and fund, the improved returns draws more investors to the fund, more money flows into the fund, and the cycle repeats. Now, the problem with this argument or assertion that price discovery isn't happening and instead these stocks are just being bid up by momentum is if that was the case, you would expect companies and passive index funds to be more expensive than their counterparts that aren't in the passive index funds. The problem is that's not the case. Analysts at Bloomberg pointed out in September of 2024, stocks with higher passive ownership, higher decile, aren't any more expensive than those with less passive ownership, lower decile. The data clearly illustrates that price discovery happens whether or not a stock is passively owned or actively owned, meaning that even with 60% passive ownership, there's still enough people trading around the stock to have price discovery. So aside from the claims here that passive ownership is making it so that it's just momentum driven, like Terry Smith said, there is no evidence to support that. It's just assertions. The next claim that David Rosenberg says here against passive index investing is that it's going to create market instability. People are going to rush for the exits. And again, the problem with this is there's simply no data to support it. You can look at the data of passive index investors' trades during major panic events like the COVID-19 sell-off in March of 2020, and only 10% of all Vanguard assets were traded during the first half of 2020, meaning that during one of the most troubling times throughout the past 20 years, maybe even more troubling, right? This is the entire economy being shut down. Only 10% of Vanguard assets were traded. 90% just sat still. Most people didn't do anything with their retirement accounts. So even during an event of one in a lifetime or one every 50 years, when the entire economy is getting shut down, the biggest passive index investors mostly just sat still. The data actually shows that only 15% of all Vanguard investors made any significant changes to their portfolio. And many of these investors' changes, the passive index investors, actually increased their equity allocations. So not all of them were just rushing for the exits. In fact, a lot of passive index investors aren't dummies. They use this as a buying opportunity. So critical study of the actual data shows that the major claims that these investors are making, David Rosenberg, Cathie Wood, Terry Smith, Michael Burry, all these fund managers and money managers trying to scare people out of passive index investing, their two major claims are false. They're not supported by the data. Investors in passive index funds, for the most part, they stay put during times of market volatility, during times like March of 2020. One of the scariest times in the market, and the majority of passive index investors just stayed put. And then not only that, some of them bought the market during that time period. Then the other claim of price discovery doesn't have any data to support it. Prices in the passive index funds are around the same as companies that are out of them. And it seems like there's still a lot of price discovery going on. Companies are being traded by their intrinsic value. So unfortunately, the data doesn't support their claim. What I do agree with David Rosenberg on, and what I can get behind, is the fact that the market is expensive right now, valuations are high, and that is a headwind. That I agree with him. Now moving on, the TikTok ban is imminent. It goes into effect January 19th, so we're days away from TikTok potentially being banned. Now, what does that mean? It means that the apps would be delisted from the Apple App Store, the Android Store. It means that it would literally be banned from being distributed across the US. And there's even talk of the government potentially fining or giving people penalties for using TikTok with circumventing means like VPNs. So this is a full-out ban by the law from the US government. TikTok is trying to convince the Supreme Court that a Chinese-owned company should have free speech within the US. I believe a very difficult task to do. Now, which company benefits from TikTok being banned? We have the opinion of Mark Mahaney that covers these communication companies and tech companies. Here's his thoughts on it.
Well, my guess is that the 100 million plus people in the U.S. who use TikTok are going to go where they can find the content that they love on TikTok. And you'll find a lot of that content right on Reels or in YouTube Shorts and sometimes on Snap. And so that's my guess as to where those users will go. We hosted a panel on this topic earlier this week. We think there will be a Supreme Court order tomorrow morning, just a short order. Our guess is that the majority of the court is going to vote to uphold the law. Therefore, it goes into effect on the 19th. And I don't think that TikTok goes dark on that day, but I think the service is going to degrade over time because it'll be removed from the app stores and upgrades won't be allowed.
It's not just going to go dark. It's just going to be unlisted from the app stores. So if you have TikTok on your phone already, it'll still exist. They're not going to take it off your phone. If you can't do app updates, your app is a static feature on the phone. And that's very difficult to give any type of support, any bug fixes, any feature advancements. It's basically, for all intents and purposes, it's dead. In fact, when everybody updates their phone over the next 3 or 4 years with the update cycles, phones get old, batteries decay, people update their phones, they're not going to have TikTok on their new phone. So this ban is going to have an immediate impact on TikTok on day one, but it's also going to have a gradual impact over the next 3 years as more and more people bleed from the US off of the service.
This was not quick legislation, and this wasn't something that this legislation had very strong bipartisan support. And then the arguments that TikTok was making in front of the Supreme Court, I don't think were convincing. They were arguing that Chinese assets should have freedom of speech rights in the US, and I don't think that convinced most of the Supreme Court justices. Yeah, so I think you're going to get 6 or 7 that are going to vote to uphold the law, and that's all you need.
And in fact, the US has had free speech restrictions for other countries owning things like cable TV channels in the US. The problem here is propaganda. If you give a different country an outlet, especially an adversarial country, an outlet to influence hundreds of millions of people or get a message out to hundreds of millions of people, that's concerning. And TikTok did a lot of things that I think amped up the concern for Americans. One of them was that push notification saying to call your legislator, call them and beg them to keep TikTok on board. They showed with a push notification, they could spur a huge movement of millions of different users to lobby for different political changes within the US. So ironically, the way that TikTok was able to massively influence their membership base to galvanize support overnight, to make it so thousands of their different members were calling congressional members, arguing against this bill, resulted in making congressional members more concerned about the influence that TikTok has, especially with political events. And that strategic mistake in revealing their influence, revealing their hand, was something that I think backfired for TikTok. Looking at the betting markets currently, Polymarket has a 73% chance of the bill being passed. So what does this mean for the markets? First of all, there's going to be members that defect all different places. So some of them are going to go to this new Chinese app, but others are going to go to the places they trust to get the same type of content, mostly YouTube Shorts and Instagram Reels. Out of the two, and I've looked at both of them extensively, I believe Reels is going to win. I think that Instagram Reels is going to get the huge majority of TikTok users. Reels is just better than YouTube Shorts. And I'm sorry, I say that knowing that I'm a YouTuber, I'm on YouTube, but Reels just has it down. The algorithm is better, the content's more fresh, it's more funny. I believe that most users are going to try to create a business similar to TikTok's on Instagram Reels. Even if 20 to 30%, a low estimate of TikTok users now start using Instagram Reels, that could boost their revenue by 1 to 2% over the next year. Meta doesn't need TikTok. They don't need these users. It's just additional catalyst. It's just another thing to help out the company. Meta's in a very strong position right now. Now, tomorrow morning, we have TSM, which is more specifically illustrative of the tech companies. TSM makes most of the high-end manufactured chips, which they rely on for iPhones and high-end cars, sensors. We have all that type of stuff being made and manufactured by TSM. It's highly illustrative of the entire industry. Not only semiconductor companies like Applied Materials or ASML, companies like Microsoft, Amazon, Tesla, Google are going to be impacted by TSM's earnings. Now, if we jump into this, we can look at what to expect here. The What to Watch For feature on Qualtrim is a tool I built which we feed it all of the information about the company's financials, their earnings transcripts, their future expectations, and then it highlights what are the 5 most important things that investors should be looking for going into this earnings, the biggest KPIs and things to pay attention to. And by far, out of all the different things we can look at, the top one's the most important. It highlights it here right at the top. The AI and smartphone demand for the company. This is going to be top of mind for TSM. Third quarter of 2024 saw notable increases in TSM's revenue by 12.8% sequentially, driven primarily by strong demand in the smartphone sector and AI-related needs. Investors should watch how this demand continues to influence the company's revenue streams, as TSM has forecasted a considerable 13% sequential and 35% year-over-year revenue increase for the fourth quarter. The company's advanced 3 nanometer and 5 nanometer technologies are pivotal in maintaining this demand trajectory. Companies like TSM are volatile and the demand can be cyclical and hard to judge. If I had to guess right now, I think demand's going to be very strong. I think they'll have a great Q4, and I'm guessing they're going to project a decent 2025. But we'll have to wait to see what happens. That's going to be it for this episode. See you in the next one.